The current economic rivalry between US and China and the ensuing trade war is not unprecedented in the post World War II era. In the 80s, Japan was fast emerging as a formidable economic competitor to the US. The US was left rattled at the time and had to craft a strategic response to rein in Japan through a mix of diplomacy, currency realignment, and gradual pressure. But 2025 is different, and China is not Japan. Remember, Japan wasn't a military superpower anymore after World War II. So, in the 70s and 80s, Japan was reshaping the global economy through an export driven model with state guided industrial policies, a high domestic savings rate, and an undervalued currency. The Japanese firms quickly gained dominance in automobiles, semiconductors, and consumer electronics. State guided industrial policies, high savings rate, and undervalued currency. Doesn't these terms sound familiar? It does because Donald Trump often accuses China of the same policies. Reality is all countries, including US, Great Britain, and others, employed these very same protectionist policies in their early growing phase. Anyway, back then companies like Toyota, Sony, and Panasonic not only competed with American manufacturers but often outperformed them. By the mid 80s, the US trade deficit with Japan had ballooned to nearly $50 billion. Domestic industries in the US were suffering, jobs were disappearing, and the public frustration mounted. Many politicians and bureaucrats in the Washington began to see Japan not as a partner but as a threat to American economic leadership. There are striking parallels between the Japan's trajectory in the 80s and China's rise over the last few decades. China has followed an industrial path which resembles that of Japan's, which is marked by rapid infrastructure development, export led growth, and deliberate currency management. It has emerged as a dominant force in sectors like electric vehicles, green technology, and advanced manufacturing. So, Japan had to be stopped. In response to Japan's growing dominance, the US sought to limit Japan's export without overtly resorting to protectionist policies. It forced Japan to introduce voluntary export restraints, particularly focused on the automotive sector. Although termed voluntary, these measures were imposed under the implicit threat of more punitive trade action. Under sustained pressure, Japan agreed to cap its car exports to the US, which offered temporary relief to American automakers. However, Japanese firms quickly adapted, shifting towards higher margin vehicles and building some manufacturing and assembly plants within the US itself. Then came the Plaza Accord. So, through the early 80s, the Bank of Japan actively intervened in currency markets to keep the yen undervalued. And this continued even after the adoption of voluntary export restraints, giving Japanese exporters a powerful global advantage. So, when the currency of an export driven country weakens, the companies in that country ends up earning more in domestic currency even after selling their products at the same dollar value as earlier in the developed countries. Additionally, employees of those companies who are paid in the domestic currency end up not being able to afford expensive imported products, so it helps the countries to keep higher export and lower import. Realizing this, Washington escalated its strategy. In 1985, the US coordinated with Japan and other major economies to sign the Plaza Accord. The explicit goal of the Plaza Accord was to correct the overvalued US dollar, which was exacerbating trade imbalances and enabling unfair advantages for export led economies like Japan. Unfair advantage, another word which Trump has inherited from the 80s. However, implicitly, the accord was aimed at ending Japan's policy of currency suppression, which had artificially cheapened its exports. Under immense international pressure, Japan agreed. The consequence of that was that the yen appreciated by over 100% in the next 3 years, abruptly ending Japan's era of easy export gains. The rapid rise of yen eroded Japan's export competitiveness. To soften the blow, the Bank of Japan slashed interest rates from 5% to 2.5% and flooded the system with liquidity. Initially, this stimulus seemed to work. Domestic demand surged, asset prices soared, and Japan entered a brief period of exuberant growth. But there were consequences of cheap credit as well. Real estate prices in Tokyo surged to unprecedented levels, and the Nikkei index tripled. By 1989, Japan's stock market astonishingly represented more than 40% of global equity capitalization. 40% of entire world's market cap was in Japanese listed companies. Unbelievable. Rather than fueling productive investment, the flood of cheap credit ignited a historic speculative frenzy. But as always, the bubble had to burst. You will be amazed to know that the past tense of burst is also burst. Bursted is a common error which people make. So the inevitable correction came swiftly and brutally in the early 90s. The stock market plunged, land prices collapsed, and banks were left drowning in bad debt. Remember the stock market crash of the 1992? Despite aggressive rounds of fiscal stimulus and ultra-loose monetary policy, growth flatlined. What followed was Japan's so-called lost decade, a period of stagnation and deflation that ultimately stretched far beyond 10 years. Stagnation and deflation means growth halted and prices deflated. More than 3 decades later, Japan has yet to fully reclaim the dynamism it once exhibited. China's emergence as a global economic powerhouse mirrors Japan's rise in the 80s. Like Japan before it, China has utilized state guided industrial policies to achieve dominance across multiple sectors such as electronics, telecommunications, and renewable energy. With a massive trade surplus with the US, China's export driven model has led to significant tensions between the two. But here is the twist. While Japan's debt fueled bubble burst years after the Plaza Accord, China's debt bubble has already collapsed before the trade war gained full momentum. Today, China is grappling with massive corporate and local government debt, deflationary pressures, and a deep real estate collapse. Domestic demand remains stubbornly weak, and policymakers have already exhausted much of their monetary and fiscal arsenal. It has a much narrower policy space, having already exhausted monetary and fiscal tools to stimulate growth. With limited shock absorbers left, the economic repercussions of any sustained trade war could be far more severe on China than it was on Japan. Its lost decade may have already begun. For the US, the stakes are broader and more systematic now than in the 80s, as China is also a military superpower along with an economic superpower and a manufacturing powerhouse. It's far more interconnected with the global economy and forms an integral part of the global supply chains. So unlike them, US is not adopting a stepwise approach this time. Rather, the old trade order is being completely discarded all at once. The US has already undertaken prohibitory tariff and trade restrictions under Trump's reciprocal tariff regime. Beyond protecting specific industries, the US now has to safeguard its entire manufacturing base and technological leadership, all while struggling with a historically high fiscal deficit and mounting debt problems of its own. This trade war between US and China will have global repercussions. The world's two largest economies are both on the economic precipice of their own and yet entangled in a trade war. Precipice means hanging from a cliff or in a dangerous situation with their mounting debts. This situation has brought upon us a strategic contest for global economic supremacy, much like in the 1930s. A prolonged US China conflict would accelerate capital flight from emerging markets, distort global supply chains, and rewire trade corridors. A bifurcation of financial systems, that is dollar led versus yuan aligned, may erode the global dominance of the USD, especially in commodity and capital markets, which will cause harm to other countries which hold dollar in their foreign reserves as well. The longer this decoupling continues, the higher will be the risk that neutral economies, particularly those in Asia, Africa, and Latin America, that is the global south, will be forced to pick sides, redrawing the map of globalization. The world will not be able to stand still as the two giants clash. The risk of this conflict rolling over to a military war, like it did in 1939, can't be ignored. Regional flashpoints, like that in Taiwan, could easily escalate tensions, potentially triggering wartime economic measures to address domestic economic concerns, further complicating the global stability. In the 80s, US was able to rein in Japan through a mix of diplomacy, currency realignment, and gradual pressure. It was an economic challenge with economic solutions. US might have been able to follow this stepwise approach with China in 2000s, but now it's probably too late for that. The chessboard is much larger now, the pieces are more volatile, and the players are less predictable. This is not just a trade war, it is a clash of economic systems, potentially ushering in a new multipolar world order, fractured supply chains, and a redefined financial architecture. So, in the end, two wounded giants are locked in a contest neither can afford to lose. The outcome will not just reshape industries, it could remake the foundations of global finance, fracture the dollar system, and redraw the geopolitical map, all of which have been in existence in the current shape for the last 8 decades now. The 2025 trade war may well be the first battle in a long economic Cold War. Please let me know your thoughts on this in the comments, and until next time, see ya.